Hello and welcome back to Patrick Boyle on Finance. Today we have an interview with Hugh Hendry, who is one of the most colourful and interesting people in the world of finance. We're going to talk to him about Bitcoin. We're going to talk about what investing books he likes. We'll learn about his career and how he became a macro trader. We'll learn about his new YouTube channel, which I strongly recommend everyone go over and subscribe to. And we'll learn about his new life living in St. Barth since he moved there a few years ago. I hope you guys really enjoyed this interview. Well, I'm really excited actually to talk to you because I came across your YouTube channel a little while ago. In particular, I'd say about a week ago, I came across it. And there was the interview with Michael Pettis, which I guess it's in 3 parts, but it's one of the best pieces I've seen on YouTube. Like, I just loved it. It was so smart, so interesting. And then I equally saw that your channel is hugely undersubscribed. And I thought, well, if I have you on my channel, hopefully some of my audience will see how interesting the stuff you're doing is, and we can push some views over to you. Because you put a ton of work into it, right? Like, you've got way better sort of photographic work, and I don't know. You tell me even about your ideas with what you're doing with YouTube right now.
I'm coming up to a year, so I've given myself a year to experiment and largely have fun.
Yeah,
and then take stock and try and measure what I had achieved.
Yeah,
but I was passionate about investing and the I want to say the art of investing, and I very much cut a different cloth from almost everyone else. And then I got kind of compromised whereby you could only go so far with that attitude, and I got persuaded, with the lure of the dollar, with the lure of like managing more money, to tone that part of my temperament down. And sure enough, lots of money flowed in, but my creativity, it was like an airbed. The money flowed in, but the creativity went down, and ultimately I became passionless, and also, I was pursuing, my rules were not to lose money and to be uncorrelated. And people don't understand, the wider world that looks at YouTube don't understand that mandate. It is a mandate. And it's
it definitely is. Well, it's the purpose of a hedge fund, right?
Exactly, it was. But, people just think, and I kind of sometimes confuse it, and I say hedge funds like getting the keys to a fast sports car or something. And it is initially, but when you mature and wisen up, you recognize exactly it's this pursuit of uncorrelated returns, and that has a cost.
Yes,
the opportunity cost has become so intensely high just because indices have moved higher. And anyway, so I think 2013, I'd kind of written a mea culpa letter to my clients because they began to attribute lack of correlation as being a bearish mandate, which I wanted to reject. And I put out a letter saying, what if I was to tell you I turned bullish? Is that something you'd be interested in? And they were not interested. And I knew I was playing with fire. And that marked the high point in my AUM. And we went from 1.5 billion under management right about the end of 13, and by 2017 I was under $100 million, and like I say, I was just, the fun had gone, and so we closed it down, and I had made a significant investment on this island, this wonderful island of St. Bart's, a kind of commercial property for short-term holiday lets to the uber rich, and just the island, you feel younger. And if you will, I'd always been a pirate, so I guess my destiny was to be in the Caribbean. And with this confinement thing, I needed to get out of my cave, my man cave. And initially, I had been the author of kind of quirky investment letters over the course of 15 years, and I thought they could have made the basis of a book. And a bit like I think what you were alluding to, I then pushed more to the social media and said, well, you can unveil the book with your audience in real time, and it seems like it's more discursive, and they're shooting stars in different angles and ways you can pursue that. And so that was just giving myself one commitment, was the opportunity to get out again from the cave and therefore be myself. So I'm not managing money, and I see myself as I like playing with words and messages and stuff, but I think of me as having the shock and value or lack of the graffiti signs you see in the underground,
Yeah.
The dawn of chaos, question mark, all that kind of.
I first learned about you back during the credit crunch. Working at a big firm, you'd have the CNBC screens up, but they're always muted. And the only time anyone turned on the CNBC screen was when you were speaking, because it was entertaining and it was interesting and it was fun, and a lot of the discourse on financial television actually just isn't really that interesting. And so partially what I enjoy about making stuff for YouTube is trying to put interesting stuff out there. But I'm once again excited to have you on my channel, just because I've always found you one of the most interesting people in the business.
In my head, I'm reinventing the thrill of investing, the thrill of taking investments without certainty. And so you produce maybe a thread for Twitter, or you produce an image with I have thoughts. I read, and I'm subject to the invasion of media and other people's impressions, and I'm bouncing and so trying to capture that. But then that moment when you send it, and publishing is thrilling.
Yeah.
And the opportunity to speak today is thrilling, and maybe I'll say sensible things, or maybe I'll say silly things, but that's the chaos of now.
Now, can I ask you, just because a lot of my students from King's and Queen Mary watch the channel, can I ask you to give me some background on sort of how you found your way into the investment business and how you became a macro trader? Because I always find macro so interesting, because it seems like such a challenging area of the investment world.
Well, some might say serendipity, and of course, there's nothing like a little bit of elbow grease and hard work to encourage or to help with the serendipity. But my story is journalism is kind of lazy, and it likes the journey from point A to point B, especially when they are disparate locations, if you will. And so you can think of me as being, a kid from a really poor, edgy, very violent neighborhood. One of these kind of attempts to make new communities to get people out of the city center, and bad urban planning, and really bad. And of course, here I am. I'm coming to you from the principal room of my large residence in St. Barts, but again, I only get to stay here when the clients are not here. And there's a client, I hope, arriving later today. But the bit in between points A and B is interesting. The interesting point is I had such a non-decade of being a teenager. I skipped being a teenager. For some reason, I had a remarkable degree of maturity, which saw me reject my circumstance and conclude that the only escape valve would be education for a kid like me. And from the tender age of about 13, I committed myself to studying. And I recently launched a video in December, I want to say, what is it called? The cacophony, an intense cacophony. And it makes no sense unless you know this backstory. It's essentially trying to talk to those kind of that lost decade and what happened, because it was very much a monochrome of grey. I had I was in my bedroom alone. I didn't have girlfriends. I didn't smoke. I didn't drink. I rejected going to parties. Really, very, very weird behaviour. I got the opportunity to study accountancy, because that seemed to be, one a step on the ladder higher. At the end of the degree, there was a chance to do an honours year and specialise, and I found myself doing market-based accounting research with a data stream terminal. I mean, young kids today won't know what a data stream terminal was, but it was it was a graphic, it was a database where you could bring up charts of price series, and I was given a project to examine how the market dealt with signals which were potent with information that would affect the cash flow of a business and hence the valuation. And then there would be perhaps an announcement where you were changing the depreciation policy from 7 years to 10 years, or the reverse, let's say the reverse, and therefore headline your profit figures would go down, but your cash flow would be unaffected. And so kind of using statistical models and the observation of charts to determine the trading pattern behind the announcement and like 3 months after the announcement. And then, and I thought, wow, this is kind of, it got me, and that was the hook for me. And so I very speculatively made applications to investment management houses in London and of course in Edinburgh. And serendipity, there was an organization in Edinburgh that consultants had alighted upon the notion of a lack of gene diversity in their recruitment policy. And they thought, we need some local kids, so it's an easy fix. And my little application sailed in, and I was passionate. I think I vibrate at a different rate to everyone else, and part of the success that I ultimately enjoyed was hearing disturbances in the universe. I mean, it makes no sense, but I had an early antenna for change, and I had 8 years being given a very classic, very orthodox, a superb education in investment analysis, but it had nothing. It could not equip me with my shaman-like tendencies. And the root of 8 years was just grotesque disappointment, where they were disappointed and I was deemed to be a troublemaker. So I left. I went to London. I worked for Credit Suisse Asset Management for a year. Was it the right fit? And again, through serendipity, I had the opportunity to meet with Chris Benodi, and there was a meeting of minds. And he was looking for troublemakers. And at the time, I didn't know what a hedge fund was. This is 1980. When is this? This is 1999.
Yeah.
1990. But he was shaman-like also in some of his attributes. And together he taught me how to misbehave, how to be curious, how to touch things, how to deal with mistakes, how not to be fearful of making errors. Like in St. Bart's 5 years ago, I learned to sail dinghies, little lasers and the like. And you start with the ego of an adult, where you don't want to make mistakes, and then watching the kids and seeing the kids love capsizing the boat, and that filled me with dread because, oh my goodness, I look like an ass. But when you see it through childlike eyes, and you see that it can be fun, and wow, that was a major moment. And now I am the worst sailor ever. If you watch my Instagram, you see about 3 months ago I wrecked a boat, but anyway, moving swiftly along. But curiosity, and that all came from those formative years with Chris when I spent 5 years with him. And then I felt I could do it. If you can do it yourself, then you should. I felt I'd become something of he was the host, and I was some form of flesh-eating or idea-eating bacteria, and I had consumed my host, and it was really, I felt, time for me to make my mark alone.
And when you left Odie, you basically just bought out the fund that you were managing. Is that how it worked?
Yes, and that's unusual. I believe that's unusual, and that was brokered by one of the principal investors um, with money with the two protagonists. And the idea was attractive because Crispin had been a finishing school for me. He had allowed me to take those vibrations. By and large, we embraced charts, but also we were without fear. We were bold. If you go back and you read the tracks of Jesse Livermore, Jesse was buying before shorting. He would go long.
Yeah,
He'd go long just because there are neurons that are sent from sensation, like from owning things, which then go up, and then perhaps you see the world or you see the narrative from a different perspective that you would deny yourself if you just entered the position with a short. It was a soft and kind of fun things like that. Back in the day, Crispin had a methodology behind the portrayal of the buccaneering kind of and deeply intelligent, charismatic, but zany pirate. And there was an orthodoxy. And it was the orthodoxy that I latched onto.
Yeah.
And it was the
was that your move into macro? Because at first it sounds like you started out with kind of single stocks and looking at sort of how they were affected by various environmental changes like markets or depreciation or whatever. You then, when you went to work for Crispin, you moved into the sort of more global macro approach?
Well, again, let's use this word serendipity. The investment house in Edinburgh was remarkably thorough, and so you'd spend the training program lasted between 3 and 4 years, and there was a series of rotation, and you would spend a year in a geographical equity department. And being the junior, it was your responsibility to prepare an economic paper justifying. Typically, departments are always looking for more money to allocate, more power, more prestige. Yeah.
Mm-hmm.
But I would be, one of my responsibilities was to put an economic paper capturing what had changed in a month, and then distilling it in terms of effects, impact, and possible consequences for the future in terms of the equity and other financial assets. And then I would have to distribute that paper to all of the investment staff physically on a Friday afternoon, hand it out.
Yeah.
And then at the partners meeting on a Monday in this grand Georgian boardroom, it would be my opportunity to stand up and present to that and take questions. And it was terrifying. But of course, a wonderful induction. So I had been trained without knowing it as being, I was macro from day one.
Now, you said a really interesting thing on one of your videos a while ago, that you always look at the markets or look at, I guess, macro as if you were a regulator or a government person whose job it is to adjust things and to try and think, if I was in that role, this is how I would do things. Is that your main perspective, or?
Not my main perspective, but some of the best asset class opportunities arise where the authorities, they want you to make money. Yeah. And of late, I've been entering the fray very, very late, but saying, hey, I'm a curious guy, and gee whiz, I missed Bitcoin. I missed whatever, where this point in the path on Bitcoin, whatever. So maybe, because people will reject, what do you mean you missed it? It's ongoing, but I missed the initial 12, 13 years. And it's not that I missed it, it's just I recall, I want to say 2011 or 12, using the metaphor of Bitcoin. I said, in this environment, because for me, I had lots of procrastination. 2008 had been this tremendous high point for me. I had been one of the few cranky eccentrics that had seen the coming storm and had profited from it. In October 2008, one of the worst months really on a par with the late 1920s. I had made 50% that month. And not only that, I had made a documentary for Channel 4 in the United Kingdom. I'd been all over, back and forward, stateside and outside the Bank of England saying, there's a storm coming, beware, beware. But I then didn't capitalize upon that. And I didn't capitalize upon it because I became kind of angry and curmudgeonly, because I thought this was the Andrew Mellon point to purge the system of its rottenness. Yeah.
I thought the same thing at the time. Like it looked like this big crisis where everything would sort of burn down and be rebuilt in a more sturdy manner to a certain extent.
Choice was either made explicitly and probably implicitly to forgo that. And I actually, when I think back, because you had the portents of that with the 91st birthday celebration of Milton Friedman, when Bernanke welcomed him, and the Fed gave him mea culpa, and they said, Milton, you were right, we were wrong. Our handling of the crisis at the late 1920s was catastrophically bad, and all we did was we accentuated the cycle. We made it worse than it had to be, and the next time it won't be that. And so, what was the accentuation? They were Austrian. They were hard money. They were purging the system, and it just made for a deeper, And so this time they said, you know what? If the price of avoiding 25% adult unemployment for a decade is that we kind of got to turn the other way and let off some, kind of sleazeball behavior, then kind of so be it. And I look back on that now and I say, I think in the balance of probabilities, the path that we've taken the last 12 years is not perfect. But I would choose that over what we saw in the 1930s. However, if I did mention Bitcoin, it feels like Bitcoin. I had a conversation in a panel with people on Bitcoin, and they tend to be young and very idealistic, and I tend to be the opposite of that today. And I'm fearful that they're Marxist. They're Marxist, hard money Austrians, and because of the path, I almost feel that the salutations to this God, is man making a godlike deity in Bitcoin, especially this, what is so far a promise rather than anything really, really hard, but this limit of 21 million coins. So the finite nature of it, finite makes it like godlike, I want to say, is a rejection of the generosity, if you will, and the willingness of authorities not to purge the system of its rottenness. And so I'm still not sure where Bitcoin is, because we started this long off-piece section with your question about investing and making macro asset allocations with the kind of the support of the government. You could say that trying to invest at the bottom, so trying to invest after the cascading waterfalls of the tech bubble, or indeed in 2009, being long is very much with the government's support, and so that's something. Today there's a tantalizing investment prospect in trade. I believe in trading carbon credits. Very, very illiquid, very hard to approach market. But I mention it, and I've not really. This is the first time I've really been public with that notion. And full disclosure, all of my money is tied up doing property investment in St. Bart's. If I did have funds, I would very much be committing to European carbon credit futures. And the reason is the one that you alluded to, in that the governments of the world have pledged these zero carbon emissions. And the more that those carbon credits trade higher, there's a vindication of the government's attempts, and plus it kind of greases, it kind of provides a financing incentive to get us there. And so it's a very they can't shirk or hide. They've made it very, very clear their intent and the repercussions if they fail to meet those deadlines. And so here's a kind of a financial bat, and you can beat them with it in the sense of this goes higher to say, come on, guys, let's do it. So that would be an example that they're rare.
Yeah.
They're rare.
One of the things that interests me with the idea of macro is, I guess, you firstly have to kind of foresee a coming event or a high probability event. And I guess also it has to not be priced in that if you sort of foresee something that everyone else foresees, there's no money necessarily to be made. How do you deal with that? And how do you know that your ideas are kind of non-consensus ideas?
Playfulness. Let me give you an example. When would it be? Heavens. 2006 or 7. So I had I populated my head with macro conjecture. And for me, charts and looking at deconstructing the world and looking at it. To my charts were sheet music, and reading and then, if you will, sitting down with the piano and playing and the notes, like the narrative then coming up in terms of these musical notes, just allowed me to see reading good fiction. It's incredible. We are constantly processing in our heads, and you need just keys, and those keys don't have to be and very rarely are they economic statistics or the pronunciations of central bankers. More often than not, it's a really good article in the New Yorker or,
I find it so interesting that you're saying that, because I started out my hedge fund career working for Victor Niederhofer, and his famous book, Education of a Speculator, kind of related to, he's a quantitative trader, but he just looked at everything. Like he'd say, what lessons can we take from baseball about the market? He wrote a chapter on music and markets, which is kind of interesting. But I think his goal was to sort of reach for creativity in those other areas, but also to really quite deliberately not do what other people did. There was no Wall Street Journal, no CNBC to be in the office, because he felt that if you do the same thing as everyone else, you get the same results, you get average results.
Well, I never met Victor, but he was one of my, I can't call him, I'm not amused, but I mean he was someone that I admired. The book is the greatest ever first chapter of a book I've ever read, when he's talking about
the old man and the yen.
Exactly, and
yeah.
There's an author, Tim Robbins, who wrote an entire book, spectacular book, very funny, entertaining book about the travails of three inanimate objects: a sock, an empty tin of beans, and a spoon. And they're crossing America, and actually they end up going to Egypt, Israel, etc. But the ability to capture a narrative with inanimate objects, and that's so dollar yen is inanimate, but it becomes a living entity, and it's borderline insanity. And he's talking to him; he's way too leveraged, but loved that, and it made macro. That was my macro. My macro is an absurd theater of what the future and parallel universes might present. Because my point was always, my competition were the smartest people in the world. The 20% performance fee, the 2% management fee. Logically, you've got to assume, for sure, there are amazing medics, and of course, in latter years, we've had the enormous returns from tech and winner takes all. But back in the day, the greatest return on intellectual capital was financial management, and so very rational that the protagonist would be amongst the smartest people. Yeah. So I thought, it's dumb for me to think I can outsmart the smartest people. So let's like Victor, let's go fuzzy, because smart, logical people just can't deal with fuzziness, and life tends to be that. The common refrain is, when something dramatic happens, is, who would have thought that? As if it was impossible. But that was my franchise. I'd be like, kind of, that's what I set myself up to. I would be the person weighing that up, and I would have a representation of that if I could support it in a kind of low-cost manner.
One of the things that always excited me about being involved in markets was just the nature of decision making. And there's, everyone in their life makes all sorts of decisions. But when you're a trader, you make decisions and you're quickly right or wrong. And you kind of build up over time a real knowledge of sort of how good your decision making is. And it's sort of why everyone in markets in recent years, everyone I talk to talks about that Annie Duke book, Thinking in Bets, which is very much, I feel, how traders and investors think. And I almost think the most attractive thing about working in markets is just that you get to kind of play the great game, and you get to sort of work out like how good your decision making is. How do I know I'm right? Because a lot of people can just pretend to always be right, because if you don't put your money down, you can say, I think there'll be a lot of inflation. And then if it happens, you tell everyone you said that. And if it doesn't happen, you kind of forget you said it. Well, when your money's on the table, you have to deal with the consequences of being right and wrong. And the scorecard is always there.
The honesty and the honesty of the burden of being responsible for other people's money, the burden that comes from having to deal with a lot of bad information, if you will, in the sense that signal to noise. I was poor at this. I was constantly seeking confirmation. I was always nervous, and it's like Disneyland, and it's mirror, mirror on the wall, who's the prettiest of them all. So I was vain like that, and I'd be like, mirror, mirror on the wall, who's the smartest of them all, in the sense that I allowed myself to be burdened by this daily P&L, which became minute by minute P&L, which became 24/7 P&L, and I allowed myself to be defined by that daily P&L and have mood swings and engagements with my closest, which was preposterous. And of course, the feedback, the more you amped and the questioning, the feedback was, you're an idiot, you're an idiot, you're an idiot, you're a genius, you're an idiot, you're an idiot. You never heard the genius part. If you had the refrain or discipline to ask it one time a year, most likely it would say, yeah, you're on the right path. But uncertainty and people's expectations, the burden of expectations, meant you were constant. And I was constantly asking markets, at least the markets were like, call a friend. The issue for me was it's too easy to say, I committed myself to owning things which were rising, and I either avoided or I took a speculative position on the short side on things which were in a clear defined downtrend. But anyone with knowledge as a trader will tell you, there's nothing, it's an oxymoron to say a clearly defined trend.
Yeah. Well, I often find it so interesting. I spoke a while ago with Jack Schwager, who wrote all those Market Wizards books. And one of the things that I find so interesting is I often think, when I'm always interested in how people make their decisions and what they, how they deal with them. And one of my thoughts in listening to kind of how a lot of these great traders think is that I often wonder if they even know what they're doing, because I think that some people kind of catch on to a thing, but we'll say if they have a rule in there, we'll say like the trend thing, that they have a decision-making approach, and then they'll only make that decision if the trend is in their favor. I always kind of wonder, like, is that adding value or not? Like, could we is that core to what they do? or is it just noise within there? And I think that's always an interesting thing.
Well, when I started to accumulate assets, with $1 billion or so, with the management fee, that allowed you to we were investing. So at $1 billion, we were investing optically to have a $2 billion platform. And we had built, at a crazy cost, we built this fantastic database that sat on top of Bloomberg. And actually, at Bloomberg, for the longest time, we were kind of scratching their head, going, why is our damn London system so slow? And it was our beast that was just hosing down information constantly from the thing. They ended up giving us a dedicated line at the end. But we could, whatever I lighted upon, we could put, heavens, I don't know, we came up with about 25 different kind of trading strategies for trading a trend.
Yeah.
And you could put them up, you could choose like the last 5 years, 3 years, 3 months, whatever, and go through all of these, and it would tell you which was the best in terms of P&L. So if you just started at that day, what would your P&L be versus the buy and hold? And my conclusion was nothing worked. You're really, at the end of the day, even with all of these disciplines, the discretionary element cannot be avoided.
Yeah.
And so that takes you back to the incertitude. That takes you back to the examination of yourself, of your character. Because, again, on that, I'd watched, Chris Minodi was a very different character, very, very robust. So his mindset was he never made mistakes. And for sure, the business of regarding the future is littered with mistakes. You're tripping over mistakes. But those mistakes were, the authors of those mistakes were others. And that's how he dealt with it.
Mm.
And so I thought about that, is that how you win the 100 meters at the Olympics? I think there's 12 contestants. I don't think you can separate them in terms of their physique, their desire to win, their preparation. And yet with breathtaking small gaps, one person owns the zeitgeist. And so I was very intrigued about that. And then I was terrified that to have that level of, let's call it conceit, I feared that would jeopardize the duration of your career. And the thing is, I loved doing it. And the thing that was probably uppermost in my mind was I wanted longevity. I thought there would be, again, a positive signal to be derived from longevity. And I guess I got it. I got 15 years, which is longer than a lot. 15 years with unorthodox, uncorrelated returns, and we eked out about somewhere a 7 with a point number.
Yeah. Now tell me about what you're doing in St. Bart's, because I read a little bit online that you're developing properties, but both, I guess, high-end and affordable. And, you can always recognize English tourists when they're abroad because they're looking in the window of the property websites. And so I forget, I Googled St. Bart's real estate a few days ago. And I think the first place that came up was around $45 million. So then I thought, let's sort from low to high here. And the cheapest was around $2 million. So it's tell me about what the real estate market there is like and why you're excited about it.
My soul collapses when, rightly, people would refer to me as being a property developer or speculator. It's like, oh, really? I'm that person. It's like, Daddy, what do you want to be when you grow up? I don't think anyone says a property developer. They should, but the affection with which I hold it is that it's almost like living in the Truman Show. It's a macro play, and I'm actually 3-dimensionally within the portfolio. I can touch the walls of the thing. And that's kind of intriguing. Now, why is it a macro trade? It's a macro trade because it's an alternative asset in the sense of gold, and we mentioned Bitcoin, and we could mention several others. And the allure of alternative trades typically is how they stand how their supply function is different from financial assets. Like they're no one else's liability, that it's hard to replicate them, that the supply of them is typically either, or everything's kind of finite outside, the paper fiat currency system. And this is an area where you've seen the rise and the rise and the rise of LVMH. And it's funny because one of the challenges I set myself 15 years or so was to say, what's so special about European markets? With the US, that's a kind of easy call. It's the tech. It's that deep channel of being able to create. With my Michael Pettis interview, he was relating to the fact you can take someone from the DRC and put them into Belgium and train them, and they will be remarkably productive. It's not a function of them being from the DRC. It's that there's a legacy and a networking effect in Belgium.
Yeah, there's just sort of institutions there that they can leverage for their personal growth.
And they're some of the richest French people are to be found being entrepreneurs on the west coast of America.
Yeah.
And so in Europe, really, the only rare asset that you can buy are these luxury good brands. And what are these luxury good brands? They're actually alternative assets. They are, when people suddenly make millions, and millions now is obviously the wrong calibration, billions and whatnot. Yeah. They have to peacock, and they have to signal and demonstrate to their peer group that they are now mighty. And so if private island doesn't succeed, private islands are kind of good value. Normally, a house is a big house in St. Bart's. For sure, you could buy 2 tropical islands, but no one would see you in your majesty. No one would be there to say, "Wow, he's had a good year." So it has that.
It's funny, the growth of luxury goods. Like I remember, sort of, I don't know, like probably around 15 or so years ago, when I realized how much people could spend on stuff. Like I remember someone pointing out to me that a leather handbag cost around $2,000, or actually it was pounds, I think. And it sort of surprised me, because I often think of things in terms of their cost of manufacture. And I thought that this was a temporary point in history. Like I thought, well, this is a fashion item that will quickly disappear. But in truth, that market has only grown. Like it's not just the ultra wealthy who buy those items, I guess. But also even I wonder now if it relates to the growth of sort of social networks like Instagram and so on, where in the 1980s, like if you went around and sort of displayed your wealth to people, you'd probably either get robbed or get mocked, while nowadays people can have an Instagram page and it's all just you next to a Lamborghini or getting onto a private jet or whatever. And I think that the luxury goods business has just really taken off because of social networking.
For sure, the dissemination of that, and of course the enormous expansion in the available customer base as we took China from peasants on $1 a day to, on average, citizens earning $10,000 a year. And of course, that is such a wide pool that you've got a population greater than the Netherlands who are richer than any of us, sort of thing. So that's been to the fore. But at the same time, they have been diligent in the control of the supply of those leather bags. They only issue X number, and they're marked and they're numbered and they're registered, and they're typically given to, I guess, influencers and special people. Eric Clapton was one of the, he was one of the first, if you will, celebrities back in the 60s, really, to recognize the watches, the Swiss watches. And they are an alternative asset class.
It's interesting because I was just kind of before our call, I saw an article about the ramp up in, limited release sneakers, like, trainers. And I kind of wonder, like, I do think that that marketing has moved in this direction, like the whole story of what are they called, Supreme, have kind of worked out this sort of scarcity and this drop market of modeling. But to a certain extent, I also wonder if there are just all of these kind of mini bubbles that relate to, when the Federal Reserve sort of cuts interest rates to zero, like maybe the kind of person who used to own treasury bonds now buys a classic Ferrari and puts that away as a sort of something that will hopefully maintain its purchasing power.
Let's kind of try and make it relevant for the kids watching and stuff in that. So one of my retorts, and I please let me just carefully say that I have nothing against Bitcoin. I welcome it. At some point, I can imagine I can't imagine actually owning it in an electronic vault, but I'm more than happy trading it, either being long in an ETF or there's now futures that you can trade it. I don't like, I wouldn't regard today as an entry point. Today's price, I think, is about the high 50,000s, and I may well be wrong with that. But one of my, so despite all of that, and only kind of positive vibes for whatever it represents, one of my retorts is, do I really need it? Because I can protect myself from the vicissitudes and the uncertainties of central banks. So, we're a macro platform here, so let's get it back to that real macro level. And there's this, I want to say, manic fear and almost misunderstanding of the role of central banks. I mean, today we are Thursday, the 24th or 25th of February, and I read an article about the sell-off in the bond market this year. It's been a remarkably weak year, really big sell-off, and the newspapers, the Financial Times, are full of these kind of, wow, we're going to have inflation because we're now combining big fiscal response with this incredibly generous and very accommodating monetary policy. And when the vaccines come through and people start spending, and already headline inflation figures are the highest in a year. Now, there's a real lie in that last statement. It's really, really bad journalism. Like, there is no import. There's nothing of utility that comes from saying that the last economic report for inflation was at the highest level in a year, because the last level for a year ago was really, really low, and it was really the same level as a year before that and the year before that. So nothing's really changed. It's an erroneous, it's trying to create a wow factor.
You pick the one data point, like you can make something stand out by a short enough time frame.
So I want to give you again a picture of how my mind works, and we'll talk about bonds. But just to finish the Bitcoin thing, so the fear is now it's the hyperinflation we're going to get as the Biden fiscal thing comes in at the same time, and that itself is to ignore completely as normal the Japanese experience, where, remember, they've taken their government debt to GDP from 65% of GDP to 265%. They have had 27 different iterations of quantitative easing. They own the bond market, and they pretty much own the equity market, and they have failed to generate inflation. Okay, so anyway, do I need, but let's say this is the one point to fear, the inflationary consequences of monetary and fiscal policy coming together. So I need Bitcoin because of the finite supply, and because of all of that money. Even more money is going to be sloshing, and speculatively, we'll see like a bubble, right? And there's nothing to. If you own an asset, you would welcome a bubble as long as you're prepared to try and sell it at higher prices. But for me, I like today's financial system because I can see those threats, okay? And so back to what I'm doing macro in St. Bart's, I can have a house, I can finance it. So I can have a house in an island which is much sought after by very wealthy patrons. It's a house where there's almost reverse mining in terms of the building applications, and the permits are getting tougher and tougher. So the house that I built in 2015, never built again, never in terms of that size and that proportion. And I can borrow money from a bank. I can fix the rate for 20 years. And if there's an inflation, effectively, I have constructed a transfer of wealth from the shareholders of the bank to me. At the same time, at very little cost, I could go and buy a variance swap, betting on a call structure on the S&P way out of the money at 50,000. What do I have to fear? So I don't need gold, and I don't need Bitcoin.
The thing I've always struggled with the Bitcoin idea is it's not obvious to me what problem it solves. Like it's put forth as this amazing technology and so on and so on. But I just don't really know, like, what real problem it solves.
It has two, without a doubt. It gives individuals, it lends you financial sovereignty in that it is portable. So you may find yourself like the poor folk in Myanmar or whatever, where democracy is usurped by military juntas again, and the first thing they do is pull the cord from the internet, and that's a big problem. But that if you can get into a domain like the rest of the world, you can re-engage with your wealth. So that's fabulous. That's fabulous. The portability. And then secondly, if they can hold to this absolute limit of 21 million coins ever mined, then compare that to, gold and the annual production of gold probably means that in 70 years' time, we'll have produced the same amount of gold as we ever had in the last 5,000 years.
Yeah.
So there's a big slippage relative. So again, I've got nothing against gold. But the imaginative macro mind can create these realities. So for me, let's talk about bonds. I put out a Twitter thread, I don't know, maybe 2 before Christmas, early December perhaps, and looking back at the end of the bear market for US Treasury bonds in 1980, I think it was 1981, and it's fascinating. You really have to go back and look at it and think of yourself as a trader. And indeed, I was reminded of the very there's a legendary hedge fund manager, so legendary, he'll kill me, I can't remember his name, but your students will scream at the screen saying, "You mean?" But he actually got sued by his clients for style drift, for committing so much to bonds because he lost.
Wasn't that Steinhardt? He was
Steinhardt,
sort of
Richard Steinhardt. Thank you very much. And he went big, and of course, being early can be early by 3 months, by 6 months, and it can still be goddamn awful.
Yeah.
And they would say, "Hey, for the last 10 years, you've been making a bundle in equities. What are we doing in these damn,
Yeah.
But he had and so if you go back to that point, remember, Volcker had raised interest rates starting in 79, coinciding with the second oil price-induced recession. And the first recession, oil recession, 73, 74, 75, I mean, that was a huge, in terms of nominal GDP shrinkage, we have never seen anything of its like. And the 79 one was, so that being in your rearview mirror and knowing that the central bank is actually raising rates going into another similar thing. And so by 81, inflation was just only going, it was visibly, the data was pointedly telling you it was abating. And anyone with a heartbeat or with their brain working would look around and say, "Oh my God," and yet bonds sold off, they sold off, they sold off, and they sold off, and the yields reached what was the high point, 17% or something?
Yeah.
And so that's the drama and the insanity of turning points. That the market, because it's been in a bear for so long, is capable of ignoring reality at the final stage.
Yeah.
So I like to think that everything comes to an end, and ultimately the bond bull market will cease, and it will be followed by a bear market. So my conjecture
now,
is,
how do you time that? Because my problem is, I guess back in 2001, I would have said the same thing. Like, interest rates were at an all-time low, and September 11th had happened, the rates were cut, and you would have said, well, they kind of only have one way to go. But here we are 20 years later, and that was. So how do you time that?
I can only offer the opinions from someone who tried. Yeah, I would say who succeeded, but I can tell you, I've got dirty experience. My hands are dirty with trying to maneuver and to engage and orchestrate my tactical positions with that. And foremost in my mind was the notion the most important thing is rejecting point A to point B, because there's a bit of, okay, bear market is over, bull market begins, or bull market is over, bear market begins. That is very linear. And what you have to throw into the mix is you're dealing with a psychopath, that your opponent, you're at the poker. I don't play poker, but you're at the green blaze, and the other guy or girl are crazy, and they don't seem to like you, and they will do anything to try and upset the apple cart. And most famously, boring everyone with this analogy, it is the disciples of Jesus in the Garden of Nazarene, and the guards come knocking. They're like, "Hey, have you seen Jesus? Jesus?" And they're like, "Who?" And they're like, "The guy with a beard, the guy that kind of cures people." And they're like, and these are people, they know that he is the deity. He is the man, right? He's got their back. Their future is assured. They have seen the future, and it is golden, and they are part of it. They're at the center of it. And what do they say? Never heard of him. Never heard of him. That's how you have to think about investing. And that's why Bitcoin and a lot of the Twitter comments, people reject that knowledge. I'm never going to sell it. Sure you are. You just don't understand the story of Jesus. So that's my point. So I emphatically still believe that US Treasuries will probably trade zero and possibly trade negative. I have a theory about that, which is that would be how I would seek to change. So everyone pursues this false theory of the US and it's not really Charles de Gaulle, but the Charles de Gaulle era, where they came out with the US as this really unfair advantage because it gets to denominate its liabilities in its own currency and it can print more and more and more. And that may have been true, but the US has come to be held hostage by mercantilist nations who accumulate its treasury bonds, and they do so with one reason, which is to kind of interfere with the normal operation of markets. Normal operation of markets would arbitrage still today the deep competitive advantages that China enjoys vis-a-vis the US, and which is revealed in trade and current account surpluses, and that is managed by the accumulation of treasuries. And so, and what we've seen in the last 3 decades, they have been a golden. The winning strategy, vol adjusted, has been to be long these fixed income securities. They've beat the S&P. They've trounced gold, and so actually you'll never stop them hoarding treasuries. And so what I would do is I would try and encourage an environment where treasuries traded negative, because at that point you would be creating a wealth transfer from creditors to debtors. And let's just remember that I have nothing against creditors, and the genius of the market economy, it brings debtors and creditors together. Debtors are the people who change the world, people with ideas, but they have a deficit of financing. And creditors is the opposite. They were that guy, and now they've got the inverse. They've got much savings, and the market-based economy brings them together with the price of money, which allows them to engage. But what all of these vol-adjusted charts tell us over the last 3 decades is that the creditors have been over-rewarded. And if we are to deal and find remedies from the kind of mini rolling depression that we find ourselves in, really, I want to say since the tech crash at the turn of the century, then you need to invoke that transfer tax. It's already there. We've got negative real rates of around 100 basis points, and that's the wise. We've never really seen that in modern economies, and I would just push it further. So it's that's the kind of dialogue that you have to be having.
Yeah. Now, I guess I can't keep you here all day, but one of the questions I wanted to ask you is, what books would you recommend to people who are interested in learning about macro investing, or sort of expanding their minds and becoming great macro investors?
Good question. You find your own, and with curiosity, you find your own books. But it's a very important question, because people forget that the intelligence is just taken as a given, right? In terms of coming into this arena, right? Everyone's damn smart. So kind of arriving going, hey, look at my grades. It's like, yeah, okay, I think you should leave. It's the person that comes in. I always hired eccentric, kind of crazy smart people, but crazy enthusiastic, passionate people. Yeah, and there were people like me. So you mentioned Schwager, Jack, and they were like boys on adventure. I must have been 23, 24, but I read them as if I was 12 years old. I read them with the torch, with the duvet over me at 3 a.m, turning the pages, because you didn't have Kindle back then. And the stories these were mad people. These were people that really lived. These were people that separated themselves from civilization, lived in mountains and by lakes, and people who, there was a story of one guy, and he had a grenade, and he'd pull the pin, and he'd put the pin back in. These crazy people going to the darkness, touching the void, is where you have to go if you want to have some aspiration to pick up a vibration of change that's coming. And so Jack's still there. Those books, of course, thankfully he's making new books. But when you can touch and feel the personality rather than this dryness which can surround macro, the Bible, of course, of macro investing, and help me with names. I do too much partying in St. Paul's. The Manias, Kindleberger, Manias, Panics, Manias, Crisis, that is the temple of all rational thought with regard to macro investing. If you had keenly pursued its logic in the last 20 years, you would be out of a job. Because it definitely pertained to a world where central bankers were a little bit more hard money and a little bit into purging the system. They were definitely into purging the system when it's the IMF and they're doing bank bailouts in other nations. But when the bailout comes more to home, they're like, we'll forgive them a little bit. Another book which had a big influence on me was by a strange source, but by Niall. I call him Niall. He hates them. I call him Niall. But Neil Ferguson.
Oh, yeah.
Economic historian. And I think, was it his Cash Nexus? All of these things, all of that stuff swims in my head. I have a pool of colors and names and stories, and they all come up without. My filing system is incomplete. It's not orderly. But he had a book which took you back through all the European misadventures with war and sovereign expansion, and he spoke to the world of history with the numbers, with GDP and the debt to GDP and the budget deficit and that was wow for me. That, like, to see history painted by numbers was a big important thing. But I can't emphasize enough that you need to be in an interview. You have to glow, right? It has to be, whoa, this kid he's read even more than I have. And again, I mentioned Livermore and the Adam Smith. Remember, it was a Wall Street journalist, so it wasn't his name, but he took on the moniker of Adam Smith. And the Money Game, an amazing book, really written so well. So there's many out there, but like
I read a while ago that you're in the process of writing a book. Is that coming out?
Yeah, that's more a bit like, hopefully a bit like Keith Richards.
I have a signed copy of that, but it's one of my favorite books.
Well, indeed. So I am not writing a treatise on monetary policy or macro investing. I am writing about I'm trying to capture the elements, the boys' own adventure stuff from Schweger, the thing where what happens next? No, that's crazy. No, so we're writing it with real pace. To British viewers, I'm not ghostwriting, but definitely my collaborator who's actually putting it all into words. He writes, and he wrote for the kind of the rock music pages for the Sun. And the Sun is a daily, or was a daily. I don't even know if it's distributed today. It had a bit of a salacious kind of downfall. But the journalism is excellent. The ability to it punches. Sentences are short. It's like poetry, and so I read the early year section, which is always the snooze fest. Even the Keith Richards, really, come on, can we skip? Like, tell me when you start taking drugs and like hanging out with beautiful women, okay, right? But that section, it made me laugh. So if we can continue with the pace, I'm going to be very happy. I'm going to self-publish, I suspect, and that'll be over the summer.
Now, the most important question I have for you, though, is where do people get the Hugh Hendry hat? You've got a bunch. You've got the surfer hat, the locals only hat. Where do people get these?
Well, the locals only is a Californian mark, Aviator Nation. They have a website. And the locals only there's something evocative about that. And if and it's a bit Bitcoin-like as well. It's like you're either local to the community or you're not. And I find when I'm traveling, the passport counters, they always kind of push back and they always go, hey, then I have my own two brands. So I'm trying to create a series of these ultra luxe villas on this island, and we're marketing it under the logo of Blanc Bleu. Blanc Bleu is very evocative of those Ralph Lauren seaside. Ralph Lauren is a genius narrative maker, and so Blanc Bleu captures everything that makes me feel happy about the sea and being relaxed and the rest. And so we have the Blanc Bleu hats. And then I'm now I'm trialing my other brand. I walk around, can you believe my narcissism now literally knows no limits. So I don't know. Hey, I've got 5,000 subscribers on my YouTube, but if the thing ever takes off, then I'm sure we'll be sending out hats on request. For sure, come to St. Bart's and we'll have a drink and you'll certainly get a hat.
That sounds like fun. Do you make it to London at all, or?
Yes. Yeah.
I do this annual conference at King's College, an investing conference. Obviously, once this pandemic is over, it'll start up again. And if you happen to be in London, it would be amazing to have you pass.
The LSE and their kids, it's a bit like Bugsy Malone, but they do they get the brand of the college or whatever. They get big supporters, and they put on a hedge fund day, and they get an amazing pool of managers and stuff. I did that one year, and it was fun. I like the energy from speaking with kids.
Yeah, it's a fun event, and I think it'll be just even better once this is over. It'll be, I think, quite a celebration to be in packed rooms once again. So,
yeah.
Okay, well, I will let you go. Thank you very much. And actually, I'm very much looking forward to when your book comes out. And maybe once it comes out, I'll read it and we'll have a talk about that in a while.
When it comes out, I'll be in deep hiding. But yeah, I look forward to that. And thank you very much.
Sounds great.
I've certainly enjoyed the hour.